All right, let's dig into our topic of the week, topic of the day, topic of the week. I know that when we were looking at the chart, kind of creeping up, the activity was a bit limited. But since yesterday and since we broke out of that channel, it seems as if the activity is picking up, and you kind of can gauge this by the VIX. And
Mhm,
we had an opportunity, or you called out last week. It looks like
mhm.
there's a little extension. The VIX, what are you thinking? What are you seeing?
Well, so the VIX did do like we said, and so for the last 2 weeks, we were telling people it's time to go ahead and place that new hedging trade, and I got a lot of questions if I could remind people how that works, so I thought for our topic of the day that I would kinda dissect that a little bit. So, last Friday after we kind of issued that, I added to my holding of my VIX. I call it my portfolio hedging position because this is a position that if your whole portfolio goes to heck, this position will go really well. And so let's talk about just some of the basis here. The idea is that the VIX is a measurement of fear versus confidence, right? If you're confident, the VIX goes down, and if you're fearful, the VIX goes up. And traditionally, if we look at the VIX over time, I'm going to show you the VIX since it's been calculated. So this is from the mid 1980s. The VIX goes up every time we have something happening that's very fearful, right? This is the whole dot com area. This was the 2008 crisis. This was the pandemic. And you'll notice that it's just a psychology experiment, Sip. It's like we only as human beings can be so confident, but we sure can be fraidy cats, right? We sure can have a fearful moments that far surpass ever the amount of confidence we get. And that's kind of the basis of this trade. So if I bring us back to the more current data, the idea is we know that the VIX is starting to trend up back towards the kind of more fearful side. We know that the mean of the fear, meaning the average of the fear all time, is up here around $19.25, $19.30. So we're still more confident than we have been in the past, but we're edging up on the fraidy cat side. And that even though we're edging up, we have these moments recently where we get more fearful than confident. And we have had this moment of confidence in the past 2 weeks, and we've been saying, place this trade. So, what this trade is, I'm going to show you kind of a neat little graph. This is called the risk profile. And so, what we do, again, this is along the x axis. Let me give you some bearings here. This is the VIX price, right? And so, if the price goes up, we get more fearful. If the price goes down, we're more confident. We know that, again, the psychology is, or the theory is that we only get so confident, but when we get fearful, there's no limit to the amount of fear we can have. It can really shoot up high. And so what we did was we created this trade between 13 and $16 that if we stay in that range, we basically make the amount of money that we got in the first place, right? And I'll explain that a little bit better in a second. But if the fear does shoot up, we can really cash in. So let me dissect this trade even further for you nerds out there that really get into the option stuff. So it's basically two vertical spreads, and you can see that they look like vertical spreads. This is the profit and loss diagram for a vertical spread. And the one vertical spread is a credit spread, right? So it's called a bull put vertical credit spread. And on this credit spread, I was able to create a credit for 17 cents for each option share or each vertical spread I did. Now they go in lots of 100, and you can do as many contracts as you want. And then to buy this debit spread, it cost me 16 cents per share. So basically, if nothing happens, If we stay between this $13 and $16 zone, what's going to happen is that the credit spread is going to go down to zero, meaning that I made a credit of 17 cents. I won't have to give any of that back. It'll just expire worthless. That's what's going to happen to the credit spread if on the expiration date, this is the third Friday of April, if I'm above $13, that credit spread is going to go to zero. The debit spread is also going to go to zero. The debit spread only goes to full value if it's above $17, right? But at at the $16, it's also going to go to zero. So the difference that I got in the beginning between the 17 cents and the 16 cents, that penny, I'm going to get to keep that penny. And that's going to help me pay for all the commissions. In other words, if the VIX doesn't do anything, that's fine. I'm going to have a break even trade, pays a little bit for the commissions. It's not going to cost me anything. However, if fear takes off and that credit spread still goes to zero, but the debit spread goes to full value, which is a dollar, I mean, I could make a fortune here, right? It cost me a penny to get in, and I'll walk away with 99 cents, right? You can't go wrong with that deal. That's like 100 to 1 payback. And this purple line represents the cooking value, like the value that it's worth as we get closer to April 17th. So even if I wanted to exit this position early, right, where are we trading on the VIX right this minute? Let me take a look. The VIX is currently at $16.14. Yesterday, it hit a high of 16.92. So if we come back to our graph, 1692, I mean, I'm talking about a pretty almost halfway, if not further, towards that $1. I could get 50 to 1 on my investment if I wanted to exit it early. If I think that there's going to be more fear in the future as we approach, this is what happens to that purple curve as we get closer to the expiration date. You notice how it's getting closer and closer to that blue line as we get I'm basically simulating what happens as each day goes by until finally on the expiration date, it'll be that blue line. So it's all saying that this is a great trade for you to put, a portion of your portfolio in, maybe 10%, 20% in. If nothing happens and your other trades are fine, then great. This position will just be a break-even trade. But if something happens where fear takes over, maybe your other positions take a little bit of a hit, this thing's going to pay back 50 to 100 to 1, right? And so that's the whole idea behind this trade and why we talk about putting it on every time we're near a bottom. Right now, it's worth so much more than what it was when I paid for it like 5 days ago.
Yeah, and that line above is a an average for how far back?
Since the beginning of the VIX. So pretty much we pay attention to that mean. It's called mean reversion. If I go back, this is the line since it's averaging all of the prices since the beginning of time.
And so essentially this is a great defensive play, right? Like
That's it.
if you have a little bit of concern that the pullback on the S&P or just that the overextension to the upside has some room to go, this is one of those that will kind of counter any of those long portfolio names that you might have that, imagine like an Nvidia, right? You've been really doing well, holding Nvidia, not doing much. But when we start to pull back, those gains are gonna lessen. This is a way to kind of make up the difference.
Absolutely. It's like we, we put most of our portfolio into positions based on predictability, based on this is what we think this position is going to do, and we're going to invest in it. And so when we see the VIX go up, basically that means that the predictability is going out the window. So by putting this trade on, that if the predictability stays where we expect it to be and the rest of our positions do what we expected them to do, this trade will be a break even trade. But if all of a sudden something unpredictable happens and the rest of our positions are in question, this trade will go ahead and hedge that. This trade will go ahead and, shoot to 50 to 1, 100 to 1, and offset anything that might happen because of the unpredictability. So this one profits on the unpredictability.